90 days ago, I handed $1,000 to an AI. No emotion, no gut feeling, no watching CNBC at 6 a.m. Just cold, algorithmic logic making every single trade. And what happened was not what I expected. My name is Maya. I used to build quantitative models for a hedge fund, and I've seen what happens when you let math run the show. But this experiment? This was different. Because we're not talking about a billion-dollar fund with server farms and PhDs. We're talking about $1,000, the kind of money a real person actually has. Here's what most people don't understand about AI investing. It's not magic. It's not a crystal ball. It's a system, with rules, with limits, and with very specific conditions where it wins. So I set up the experiment properly. One portfolio, $1,000, real money, real market. AI makes every decision. I watch, I document, I don't interfere. The rules were simple. The AI rebalances every week based on momentum signals and volatility filters. It can hold cash. It can hold ETFs. It cannot pick individual stocks. And it cannot panic. That last rule, that's the one that matters most. Because markets are designed to make you panic. Every dip feels like a crash. Every rally feels like you missed it. The AI doesn't feel any of that. I'm going to show you every move it made, every week, every decision. The good ones, the ones that hurt. And the twist at the end that changed how I think about all of this. Day 1. The AI receives $1,000. And it does something I did not expect. It holds 40% in cash. Not because the market is crashing, not because of any news event, but because volatility signals say the risk-reward right now is below threshold. So it waits. Most investors would have been fully deployed by day 1, sitting in stocks, feeling productive, feeling like they're in the market. The AI doesn't care about feeling productive. It cares about edge. Week 1 ends. Portfolio, $1,000. Cash, $400. ETFs, $600. Return, flat. The market is up 0.8% that week. We underperform. Week 2. Something happens. Tech sells off, down 3% in 2 days. The AI increases equity exposure from 60 to 75%. It's buying the dip, algorithmically. This is where human psychology fails. When prices drop, humans get scared and sell. The AI sees lower prices as better value relative to its models. No hesitation, no second guessing, just execution. By the end of week 2, the portfolio is up 1.4%. The market recovered and then some. We caught it, not by predicting it, by having a system that responds to it. Week 3. Earnings season starts. Individual stocks are swinging 10, 15, 20% on reports. The AI ignores every single one. It's not in individual stocks, remember, only ETFs and cash. This feels boring. This is the point. Week 4 closes out month 1. Total return, plus 3.2%. The S&P 500 that same month, plus 1.9%. We beat the market by 1.3 percentage points in 30 days. Now, before you get excited, 1 month means nothing. Any idiot can beat the market for 30 days. The question is, what happens when things get hard? Month 2 starts with bad news. Federal Reserve signals rates are staying higher for longer. Markets drop, bonds drop, even gold drops. Everything is correlated, and correlation means nowhere to hide. The AI does something surprising. It moves 70% into cash. Not 20, not 40, 70. Just sitting there, doing nothing. My human brain is screaming, "You're missing the recovery. What if this is the bottom? You're being too conservative." But I made a deal. No interference. So I watch. Week 5, week 6, market keeps sliding. The AI stays in cash. Portfolio barely moves. S&P down another 2%. We're down 0.3. The boring math is working. Week 7. The market hits a local bottom. Sentiment is terrible. Everyone is calling for a recession. The AI starts buying. Slowly. Systematically. 5% here, 10% there. Not because it knows this is the bottom. Because the volatility signals start normalizing. The risk-reward calculation shifts back into range. It doesn't predict, it reacts, faster than any human can. Week 8. The market bounces hard, up 4% in 5 days. We're back in equities. We capture most of it. Human investors who panic sold in week 5, they missed it entirely. End of month 2. Our return since inception, plus 4.8%. The S&P over the same period, minus 1.1%. We're outperforming by nearly 6 percentage points. And here's what I notice. The AI didn't do anything brilliant. It didn't predict the dip. It didn't call the bottom. It just didn't panic. And it didn't get greedy. That's the entire edge. Month 3. The market stabilizes. Economic data comes in mixed. The AI settles into a rhythm. 65% equities, 35% cash and short-term bonds. It looks almost human now. Week 9. A company I used to cover at the fund releases earnings. Beats by 30%. Stock up 18%. I could have made that call. I know this company. But the AI didn't hold it. And that's fine. That's not the game we're playing. Week 10. Something fascinating happens. The AI starts increasing exposure to international ETFs, Europe, emerging markets, Southeast Asia. It's seeing something in the correlation data that I hadn't noticed. Turns out the dollar is softening. International assets outperform when the dollar weakens. The AI doesn't read Bloomberg, it reads the numbers, and the numbers told it to shift before the headlines did. Week 11. Volatility spikes again. Middle East tensions, oil price surge. The AI reduces equity exposure back to 50%. Not because of the headlines, because the VIX crossed its threshold. I'm watching in real time. No emotion, no narrative, no fear. Just signal crosses threshold, execute rule, move on. This is what systematic investing actually looks like. It's not exciting. That's the entire point. Week 12, final week of the experiment. Market is quiet. The AI makes no changes, just holds its positions. Lets the thesis play out. Day 90 arrives. Final portfolio value, $1,078. Return, 7.8% in 90 days. Annualized, that's roughly 31%. The S&P 500 over the same 90 days, plus 2.4%. Now here's where it gets interesting. Because 7.8% sounds great, but that's not the most important thing I learned. The most important thing I learned is this. The AI made 17 trades in 90 days. I would have made probably 60. Every unnecessary trade is a fee, a tax, a mistake waiting to happen. The AI was lazy in exactly the right way. Second thing, the AI held cash for 26 of 90 days, more than a quarter of the experiment fully or partially in cash. Every financial advisor would tell you that's wrong. The results say otherwise. Third thing, and this one surprised me most, I asked the AI to explain its worst trade of the experiment. Week 3. It bought an energy ETF that dropped 6% before recovering. Its explanation. Momentum signal triggered entry before volatility filter confirmed. Rule conflict. Suboptimal execution. It knew it was a bad trade. It did it anyway because the system said to. That's the real question with AI investing. Not can it beat the market, but can you trust a system you don't fully understand to make decisions with your money? That's a psychological question, not a math question. Here's what I think. The AI isn't better than a great human investor, but it's dramatically better than an average one. And most people, including most professionals, are average. That's not an insult, that's statistics. The average retail investor underperforms the S&P by about 1.5% per year. Fees, timing mistakes, emotional decisions, year after year, compounding in the wrong direction. The AI eliminates most of those mistakes by not having a nervous system. So what's the conclusion? Should you hand your money to an AI? That depends on one thing: your self-awareness. If you know you panic selling corrections, if you know you chase returns after a hot streak, if you know you check your portfolio 17 times a day, then yes, a rules-based system will beat you, reliably, every year. But if you can build a system, stick to it, and not look at it for 3 months, then you might not need the AI at all. Because what makes AI powerful isn't the artificial intelligence, it's the discipline. Next video, I'm going to show you something that makes most people uncomfortable. The math behind buying a house. Not the American dream version, the actual numbers. If this changed how you think about investing, drop a comment. Tell me what question you want me to answer next, and I'll see you in the next one.